I'd like to pause a minute and just express our gratitude to our podcast sponsors, Noble's Food and Pursuits. This renowned restaurant group has been serving the community for an impressive 40 years, starting with Jim Noble's original restaurant, J. Basil Noble in High Point. Over the years, their passion for hospitality has flourished, leading them to expand into a diverse collection of 9 restaurants, a retail bakery, and a catering company. Today, we want to shine a spotlight on one of their beloved establishments, Rooster's A Noble Grill, which has been proudly open for 31 years right here in Winston-Salem. Now, Rooster's is known for its commitment to offering a seasonally inspired, regionally cultivated menu featuring mouth-watering wood-fired meats, poultry, and vegetables. If you're looking for a delightful dining experience, they also host monthly wine dinners and provide live music on their inviting patio every Tuesday night. Now make sure to pay them a visit at 380 Knollwood Street, and to secure your spot, head over to theroosterskitchen.com and make a reservation. Again, that's roosterskitchen.com. Trust us, you won't want to miss the delectable dishes and warm ambiance that Roosters has to offer. Now, let's continue exploring the world of finance and uncovering some strategies to help you achieve your financial goals.
Welcome to the Semax Way, the definitive podcast for mastering finance, investment, and retirement planning. Prepare to unlock the secrets to financial success as we delve into lucrative investment strategies and provide expert guidance towards a secure retirement. With over 20 years of experience, Semmax Financial Group has been dedicated to serving investors, and through this podcast, we aim to empower you with the knowledge to maximize your savings and achieve lasting financial freedom the Semmax Way. Whether you're a professional finance enthusiast, a high net worth individual, or part of a sophisticated investment group, this podcast is tailor-made for you. And now, here is your host, Matt Landon, financial advisor for Semax Financial Group and licensed CFP.
Welcome back, everybody. My name is Matt Landon. This is another episode of the Semmax Way. Today, I want to talk a little bit about annuities. There's a couple different things I want to focus in on that are a little less well understood about annuities, and I'd like to dive into them with you today if we can. Let's start with an overview of what annuities are and how they work. Annuities at their core are simply an insurance product. Now, there are some that get a bad rap. There's some that sound amazing. There's some that are just kind of okay. But the thing to remember with annuities is annuities are simply a tool. Now, I want you to think about when you go to hang a picture. You can look along the wall, you can find the stud, you can kind of wrap your hand along, or if you've got one of those fancy stud finders and you find out where the stud is and you take a nail, you drive it in, you hang that picture, it's not going to move. It's securely anchored by that nail to the stud. But if you're trying to hang a picture and there's no stud right there, but your spouse is looking at you saying, hey, this is where I want that picture to be hung, you've got a little bit of an issue. You've got something you got to figure out. Well, what do? For most of us, you're going to grab a drill bit, a drywall spacer, and a screw, and you're going to still hang that picture right where it needs to be. You've got to make sure that that drywall spacer and that sequence is set up in a way that it can handle the weight. But you hang that picture, it stays right where it needs to be. But what happens if you just throw a nail in the drywall and hang your picture? Well, it's going to be all right for a while. You may not notice it immediately, but over time, that nail is going to do damage to the wall, and eventually that picture is going to come crashing to the ground because it's not the right tool for the situation. Does that mean you should never use a nail? No. If you're right behind a stud or right in front of a stud, then using a nail and a hammer to hang that picture is completely appropriate. And honestly, it's more advisable. Because who is going to sit there with a drill bit and a plastic piece trying to hammer that into a stud behind the wall? You know, who's going to hammer that into the wood going, well, I have to put this in before I can add in the screw? You're going to look at somebody and go, you are not doing that right. You don't need that plastic piece at all, right? That's the thing with annuities. Annuities are a tool. Under the right circumstances, completely appropriate. Under the wrong circumstances, they can do damage. And I think that's where annuities have a little bit of a bad rap. There's a lot of people that think about annuities from the negatives. Well, there are some distinct negatives. One of them being is you're locking your money up. You're losing some of that liquidity. You're saying, I'm putting it into this product and I'm not supposed to take it out for a certain time period. That's absolutely true. You're losing a little bit of control. Here's the thing I would say around that liquidity piece. You've got to make sure it's an appropriate percentage of your overall portfolio. You do not want to be taking all of your money and throwing it into annuities. That's not appropriate. It's not suitable. And that's where working with a fiduciary is going to be key, because they're looking at you through the lens of, if this was my money, what would I want to do with it? Not through the lens of, how can I get the biggest commission possible out of this person? We talk about fiduciaries in our vidcasts on YouTube and in other areas, and I'm going to do a podcast all about being a fiduciary and a CFP at another point in time, so look out for that. But for now, I think the key thing to remember is a fiduciary is supposed to put your interest first, not their own. But annuities offer commissions. And that's something that you can't really get around. And so it's important to understand what type of annuity. How is your specific advisor who's giving you those recommendations, how are they paid? Are they getting a giant commission by putting you into this product or not? You need to understand that. The other thing is, and this is foundational to annuities, is there's three main types. There's fixed, fixed indexed, and variable. Variable annuities, they tend to have much higher fees. So variable annuities are going to be where they're linked to the market. They're in the market. You can choose kind of what sub account you want to go into, but it's very similar to a mutual fund. So you can think about it as a variable annuity is like putting your funds into mutual funds. The market goes up, your account goes up. Market goes down, your account goes down. Here's the problem with that. When you're paying north of 3% in fees and the market's up 12%, you only made 9. But when the market's down 12, you're down 15 because you're paying those fees either way. So one of the things I don't like about variable annuities is you're taking all of the risk of the market. You are losing that liquidity. And at the same time, you're inherently giving yourself a worse return. So as opposed to a variable annuity, I say just be in the market. When the market goes up, you make something. When the market's down, you don't. But you're not inherently altering your upside while also deepening your downside, right? Now, on the other end of the spectrum is a fixed annuity. Fixed annuity is like a CD. Guaranteed rate of return, you lock it in for a certain time period, it pays it back. Some of them do simple interest, some of them do compound interest. Some of them, for longer terms, give you an opportunity to take a percentage out every year. Others are RMD friendly, some are not. You want to make sure you dive into those kind of details before you sign that dotted line. Sweet spot in the middle being a fixed indexed annuity. Fixed indexed annuity looks at the stock market. Market's up, you make something. Market's down, you don't lose a dime. Many of them have no fees. Some of them do have fees. If they have a fee, it's usually because there's a rider attached to it, some kind of either guaranteed income or something to do with long-term care or a healthcare rider, those types of things, or an enhanced death benefit. The big thing I would say with that is if there's a fee, understand what it is. What are the benefits? What am I getting? So those are the three different types of annuities. One of the other big things I like to point out is, particularly with the fixed indexed and the fixed annuity, one of the things that you get from a benefit standpoint is you're giving up risk. You're transferring that risk to the insurance company. You are capping your returns. Your returns are not going to be as high as they would be in the stock market over a long period of time. You can see that historically. But at the same time, you're not taking any of the risk of the stock market. Where I like to utilize that type of a product is not to replace your stocks. Your stocks are going to be more aggressive. Well, generally speaking, what's more conservative? Your bonds. Your bonds are the more conservative side, that fixed income portion. We're not chasing as high of a rate of return inside of there. It's supposed to provide stability. But what did we see in 2022 in a rising interest rate environment? Those bonds weren't very stable. There were folks that lost 10, 11, 12% on the bond portion of their portfolio. That's not stability. And they know that they're only going to make 3 or 4%, sometimes 5% on the other side. So when we're talking about bonds, we're talking about that volatility. Well, what if we took a piece of that and put it in something that has growth opportunity with no downside? That is the appropriate place to use this tool. That is the way you want to be thinking about it. But you got to take it one step further, because annuities have a unique opportunity. It's both a positive and in some cases a negative, because annuities are what's known as a tax-deferred product. Now, if you're in a situation where you're trying to keep your taxable income as low as possible right now, let's say you're a really high income earner, and any of those capital gains or dividends, the qualified distributions, all of that kind of stuff hitting your tax return is blowing you up. You're in a really high tax bracket. Taking those non-qualified funds, putting it into an annuity affords you the opportunity to not realize any of those gains on an annual basis. If you put $100,000 in, it makes $10,000. Well, guess what? You're not paying any taxes next year on it. That's fantastic. Here's the thing. It's tax deferred. It's not tax free. Now, with a non-qualified account, this is just a fancy term that means money you've already paid taxes on. Think about money from your checking account, your savings account. This could be an individual account. This could be a trust account. This could be a joint account. This is money that is not in a retirement account, meaning it's not in an IRA. It's not in your 401k. It's not in your Roth account. Okay. This is non-qualified funds. These are dollars that you have to pay capital gains on. If you started out with $100 and you made 10, and now you've got $10 in gains. If you turn around and sell that product, let's say, think about a stock, okay? You buy a stock and you paid $100 for it. It goes to 110, you sell it. When you sell it, you've realized those gains. There's long-term and short-term gains. But if you hold on to it till you pass away, your kids get what's called a step up in cost basis. They don't have to pay when they sell it based on your sale price at $100. They only have to pay taxes on the difference between the value on the day you pass away and the day they got it. So think about it. If I bought a stock for $100, it goes to 110 and I pass away and my beneficiary inherits it and the next day they sell it at 110, what taxes do they pay? 0. There are no taxes on it. Now, if I took it out and I sold it at 110 before I passed away, I would have to pay taxes on that $10, right? Now, an annuity is a tax-deferred product. So I can put that money in there and leave it alone for 20 years. And I can roll it from one annuity to another annuity and never pay any taxes on it. Maybe I started with $100,000. It's grown to $350,000. There's been no taxes on it. But here's the thing. Your beneficiaries have to pay the taxes if you don't. It's tax-deferred. There is no step up in cost basis. One other thing to keep in mind with this is when it comes out, a non-qualified account, meaning that individual account, that trust account, right? That joint account, the money is not taxed at long-term capital gains rate. It's not taxed at short-term capital gains rate. It's taxed at your income tax rate. That's key. That's something you got to keep in mind. So when I'm talking to folks about utilizing an annuity, if we're concerned about taxes right now, but we're much less worried about it in the future, maybe using some of those non-qualified dollars that are causing you a tax problem today would be beneficial. But if you're not really worried about your tax return today, and your idea is you want to leave this money tax-free to the kids down the road, well, your IRA account, if you don't pay the income taxes, your kids pay the income taxes, okay? Your non-qualified account, if you don't pay the capital gains, your kids don't. They get that step up. So if we're thinking about it from an estate standpoint, I think it might make more sense to utilize IRA dollars inside of an annuity than non-qualified dollars. Also, these are monies that you're pulling funds off of regularly. These are monies that you're creating income, you're creating that cash flow. Do we want to be more aggressive or a little less aggressive with those dollars? So that's the kind of thing I'm thinking about when we're looking at annuities. Like I said, there's a lot you can dive into it. There's a lot of interesting things that you can use, like I said, around different riders, different benefits. But here's the cool thing about annuities. And this is the takeaway for right now. One, there are some tax advantages, but every advantage could also be considered a disadvantage. There are also some advantages from a risk standpoint. You're transferring that risk, but you're also transferring a little bit of that liquidity. And then lastly, the thing you have to consider with an annuity is this the right tool for what I'm trying to accomplish? If I'm trying to use that screwdriver and I flip it around backwards and I use it as a hammer, I can probably get that nail in, but it's going to take a while and it's not the right tool for the job. At the same time, when I'm using that hammer and that nail, it might be appropriate, but I'm wishing I was using that screwdriver and the screw, right? Think back to when you're hanging that picture. So you want to make sure it matches your risk. You want to make sure it matches your situation, that it matches what you're trying to accomplish. The last thing I'll say when it comes to annuities is this. If someone's showing you a plan with an annuity, make sure they're showing you a plan without one. There's a lot of people out there that are just trying to sell a product, and there are times where it's an appropriate product. But there are also a lot of people out there that are trying to genuinely put you in the best situation they can. And in some cases, that does utilize an annuity. In other cases, it doesn't. I think it's key to be working with someone that's going to show you two different versions, one version with, one version without, and see if it makes sense for you to utilize it. So that said, I hope this sheds a little bit of light on annuities. I hope it provides a little bit of value for you. I tried to take it in a little bit of a different tilt than where a lot of people go. I think, like I said, the tax advantages of the annuity can also be a disadvantage, and that's a key takeaway for you. That said, on behalf of the Semmax team, my name is Matt Landon. I am a CFP. We've got a number of folks here at the office that are here to help you all. Thanks for listening. Look forward to diving into the next one.
Thanks for joining us for another episode of the Semax Way. If you're not completely satisfied with your current financial advisor, give us a call for a second opinion. Please note that this podcast is intended for informational and entertainment purposes only. The content shared on the Semax Way should not be considered as investment advice. It is always recommended consult your licensed investment representative and a competent tax advisor respectively for your fiduciary needs and plans. No statement contained in the Semmax Way podcast or made by its producers, sponsors, host Matt Landon, or Semmax Financial Group is a recommendation. Semmax Financial Group and Matt Landon are not responsible or liable for investment value loss of any kind from any action taken based on information discussed in the Semmax Way podcast. Any opinions or viewpoints in this podcast are shared for information and entertainment purposes only and are not financial advice. We do encourage you to conduct further research and seek personalized advice for your specific financial circumstances. Full disclosure available at semmax.com/podcast. Thank you for joining us, and we look forward to having you tune in for future episodes of the Semmax Way.
This podcast is brought to you through our charitable partnership with Children's Home Society of North Carolina. Right now, there are more than 12,000 children living in the foster care system, and not nearly enough safe, loving homes for them. Find out how you can make a difference today at chsnc.org.